If you run a business, you're probably asking yourself, do I need a line of credit? Due to the rising costs of operations and slow cash flow, now may be the time. In this video, I will talk about what a line of credit is, how a line of credit works, how you get a line of credit, how to correctly use a line of credit, and ultimately I will answer the question, why do you need a line of credit in trucking? Welcome back to Mystery Money. My name's Nick, and if you're new here and you're looking for money tips and tricks, ways to make your business run more efficiently, or just looking for more information on how to start or grow a business, start now by hitting that subscribe button and turning on notifications so you don't miss anything. Now, before I get into the weeds on the topics of a line of credit, let me start off by explaining and defining what a line of credit is. If you're familiar with what a line of credit is, feel free to skip to the part of the video that goes into more specifics, and I will put timestamps below for reference, but if you're still here, good, let's get started. A line of credit is a short-term loan, essentially that you use for short-term expenses. These types of loans are often unsecured, meaning that the bank doesn't hold any type of physical asset like real estate as collateral. The lines of credit that I am talking about are for businesses. There are home equity lines of credit that do utilize a mortgage on your home as its collateral, but those are more for home improvements than running a business. I have seen some businesses that use this type of loan facility, but I wouldn't recommend it. The business line of credit is usually secured by a UCC, or Uniform Commercial Code. This is a lien with your state you operate in. It basically states that if you fail to pay, that the bank is the first one in line to seize the assets of your business to sell and get their money back. This is important to know because you want to use the line of credit correctly in order to keep in good standing with the bank. The line of credit is used to finance short-term expenses that should take no longer than 12 months to pay back. Lines of credit are usually renewed annually by the bank, and they look back over the previous 12 months to see how you have borrowed and then paid back the line of credit. If you don't make any payments or pay downs, basically you've only paid the interest on the line, the bank is going to look at calling the loan, or basically they will term out the loan into monthly payments. These lines of credit usually have an interest rate that is tied to an index such as prime. The prime rate is the best interest rate that any bank would give their best customer on any given day. This is the national average taken from across banks throughout the country. Currently, the prime rate is 4.75%, so you can expect a line of credit to be anywhere from 4.75% to 12% based on your business and personal credit. So how the line of credit works. When you need money from the line of credit, you will transfer it into your business checking account. Once that money leaves the line of credit, you will begin to accrue interest, and that will not stop until you repay the loan. The lines of credit usually are interest only. So if you have a $25,000 line of credit at 6%, your monthly payment is going to be $125. Now, how do you find that out? You take the $25,000, multiply by 6%, divide by 12, and that's the monthly payment. Because the payment is so much less than the actual loan, businesses are tempted to only pay the interest back. By only paying the interest, you are also not allowing your business the liquidity it needs in case it has issues such as rising costs. Once this happens, this is called an evergreen line of credit, and banks will always look to term them out. If no principal is paid back during a certain period of time, they are going to term that loan out over a period of time with a fixed payment. And if you could do me a favor, if you're getting any value so far, could you hit that like button and share this with another business owner who could benefit from this information? Thank you very much for that. Now back to the video. So what does it take to get a line of credit? You definitely should talk to your bank. They're going to ask for all of the financials that you would need to get a loan. If the only thing you're missing is collateral, they can usually get an SBA guarantee to help out with that. Most banks will go by a 10 to 15% of gross sales to determine how much of a line of credit you need. To know what to ask for, look at your gross revenues and multiply it by 10 to 15%. Gross revenues of $100,000 would look for a line between the $10,000 and $15,000 point. So once you're approved, let's talk about proper usage. You want to use a line of credit properly, only putting short-term expenses that will pay off in a short period of time, no longer than 1 year. An example of a short-term expense would be if you were going to buy inventory. Let's say you're a contractor and you need to buy lumber for a deck. You would use the line of credit to purchase the lumber, build the deck, and when the homeowner pays you for the work, you would pay back the line of credit. Another example is if you own a store. You're going to purchase inventory, then you're going to sell that inventory the following month. As that inventory sells off, you're going to pay down the line of credit for the inventory that you bought. By doing this, you're going to allow for that line of credit to purchase inventory for the next month. Utilizing your line of credit this way, you allow your business liquidity in order to keep operating. Now, how not to use a line of credit. You do not want to use a line of credit for long-term expenses. You don't want to buy a piece of equipment or any other long-term asset with a line of credit. Long-term assets should be purchased on a long-term money. If equipment has a useful life of 5 years, then you would get a term loan over 5 years. You don't want to put equipment on a line of credit. The equipment that is put on a line of credit is not going to liquidate in order for you to pay the line of credit back. Once this happens, it's not going to allow you liquidity to buy short term, such as lumber for inventory. You also don't want to use a line of credit for lifestyle creep, meaning that your business isn't making enough money for you to sustain it on its own, and then you start pulling money from the business and paying expenses from the line of credit. Unfortunately, I see this in a lot of small businesses where they're paying themselves more money than the business can handle, but they're actually borrowing money against the line of credit to keep the business running. This is a very bad formula and can cause a business to go under if not managed properly. Now let's answer the final question: why do you need a line of credit in trucking? Even if you're cash flush and never think you will need a line of credit, my suggestion would always have one in place. If you don't utilize the line of credit, you don't have to pay any interest on any of the money, but it gives you the availability if you would ever need it. Most banks are going to charge a small fee per year to have a line of credit. I believe ours for the trucking business is around $150 a year, and we have access to $15,000. Now that was based when we first got started up, and I haven't gone back to the bank to see about increasing it because we've used it properly, so we never really need over that. In the trucking business, most of the time you're going to be paid longer than ideally you would like. If you're a company driver, you got used to being paid once a week. Now, as an owner-operator, you could potentially factor, but then you're going to have to pay those increased costs for that service. The way that you avoid factoring is with a line of credit. You would charge or advance the line of credit all of your expenses for fuel, salaries, or any other expenses associated with each load. But then you're probably thinking, why don't I just use a credit card? And that's a good point. But there's some expenses that you're not going to be able to pay with a credit card, such as salaries. If you have employees, you're going to have to pay them weekly or every 2 weeks, depending on what your payment schedule is set up. For those employees, you would advance their salaries for the week from the line of credit, and when you receive payment for the loads that were delivered, you would pay back the line of credit. Another example is your insurance. If you pay your insurance one time per year, you often get a very nice discount. You advance the line of credit, you pay the insurance, and you pay it back over a period of months. You're going to pay a little bit of interest, but it's probably less than you would have paid over the full year had you made monthly payments. But check with your insurance company to make sure you can receive a discount, and then do the math and make sure if it works out better. The proper usage of a line of credit is continuous flow from your line of credit to your checking account to your line of credit. If you're utilizing the line of credit correctly, the bank can look back and see that you can properly handle the line, and they're much more likely to increase it if you need it than to term it out. So I hope I answered some of the questions of what a line of credit is, how a line of credit works, how to get a line of credit, and how to correctly use a line of credit. And ultimately, I hope I answered the question, why do you need a line of credit in trucking? If you have any other questions, post a comment below or reach out to me through my website listed in the description below. Thank you very much for taking the time to watch this video. I wish you the best of luck in your business, and until next time, have a great day.